can't believe it. I'm trying to buy a car, and when I ask for a loan, the interest rate is 3% higher than they told me a week ago. What's going on? Interest rates sound complicated, but it's important to understand them when they affect almost every important financial decision you will make in your entire life. From buying your first car to getting a credit card, paying for college, buying a house, or just saving money. The good news is that the basic idea is pretty simple. An interest rate is the price of using someone else's money, or the reward you receive for letting someone else use your money. So what exactly is an interest rate? Imagine you want to borrow $100 from a friend. Your friend says, "I'll lend you $100, but when you pay me back, give me $105." The extra $5 is the cost of borrowing that money. If the interest rate is 5%, you would owe 100 plus 5% or $5 of interest, 105 total. So that's the basic idea behind interest. Interest works in two directions. When you borrow money, you're paying interest. A bank lends you money, you use it, and then you pay the bank interest for using that money. When you save money, you earn interest. You put money in a bank, they use it to lend to other people, and they pay you interest in return. So you can think of interest as both a cost of borrowing and a reward for lending and saving. So why do banks charge interest? You might wonder, why can't a bank just lend me $1,000 and ask for exactly that $1,000 back? Because the bank is taking a risk. If the bank gives you $1,000 today, it can't use that $1,000 for something else. And there's always a possibility that the borrower won't actually pay the money back. Interest helps them compensate for giving up the use of their money, taking the risk that the borrower might just not repay, and operating the business of making loans. There's another important concept. Money today is generally more valuable than the same amount of money later. If someone offered you $1,000 today or $1,000 10 years from now, most people would choose $1,000 today. Why? Because you could use today's $1,000 to buy something now, save it or invest it so it becomes more money in 10 years. Interest is partly the price of getting access to money now instead of later. So where does your credit score come in? This is especially important for teenagers to understand. Even if two people go to the same bank to borrow the same amount of money, they probably won't receive the same interest rate. Why? Because lenders look at the borrower's credit risk. One thing they use to evaluate that risk is the credit score. A credit score is a 3-digit number that helps lenders estimate how likely someone is to repay their borrowed money. A higher score will signal, hey, this person has demonstrated that they can handle this credit risk responsibly, and a lower score means you have a lesser chance of paying it back on time and or risk your investment. So imagine two people want the same $20,000 car loan. Person A has excellent credit and this gets this lower interest rate in return. Meanwhile, person B has poor credit, so they're getting higher interest rate to offset that risk. Why? The lender may believe person B has a greater chance of not repaying the loan. Because the lender is taking more risk, they charge a higher interest rate and they make more. This creates this important relationship between a higher credit risk, meaning a higher interest rate, lower credit risk, meaning a lower interest rate. There are other factors too, including the type of loan, the loan term, income, the amount you borrow, market conditions, and lender policies. So why should a teen care about this? You might be thinking, I don't have a mortgage, why should I care about interest rates? Because you're going to make financial decisions for decades. Understanding interest early can give you a huge advantage. Imagine two people start adulthood, one understands credit scores, interest rates, saving, investing, debt, and compounding. The other doesn't. The first one is likely to make very different decisions when they get that first credit card, car loan, or student loan. And if they manage their credit responsibly, they may save a lot of money on interest in the long term. Credit cards are a great example. Suppose you eventually get a credit card. A credit card allows you to spend a bank's money and pay it back later. And if you pay the entire balance on time, you can often avoid interest on purchases under the card's terms and increase your credit score. But if you carry a balance, interest can become expensive. For example, if you have a $2,000 credit card balance at a relatively high interest rate, if you only make small payments and continue adding on purchases, interest can make it take much longer and cost much more to pay off that debt. That's why understanding interest before you start using credit is so valuable. Interest can work for you. Interest isn't only something you pay, it's something you earn. Suppose you put money into a savings account that pays interest. You have $1,000. The bank will keep paying you interest for keeping your money with them. Over time, that money will grow. Eventually, you'll start investing, and another powerful concept comes into play, compounding, which means you earn returns on the money you're already investing or putting into banks, and then you're getting returns based off the money you just grew. So if interest rate is 3% and you invested $1,000, then 1 year you'll have $1,030, and then you'll gain interest over the entire $1,030. That's one reason why starting to save and investing early can be really powerful. It's important to remember that you don't need to become an economist to understand interest rates. Just remember the basic ideas. Interest rate is the price of borrowing money. You can borrow $1,000 and you may have to repay more than $1,000. It can be a reward for saving. You can earn interest while keeping it in a savings account. Higher rates can make borrowing more expensive. Credit cards and loans can cost more. Lower rates will make borrowing cheaper, but savings account may pay you less in interest rates. The Fed influences interest rates. It uses monetary policy to help manage inflation and support a healthy economy. But keep in mind that the Fed doesn't directly choose your personal loan rate. Bankers and lenders are what are setting consumer rates, taking many factors into account. Your credit history, for example, can affect the rate that you receive. A stronger credit profile can help you qualify for lower rates. The interest can work against you or for you. Paying high interest on debt can really hurt your finances, while earning and compounding returns can help your money grow. So, in conclusion, interest rates determine how much it costs to borrow money and how much you can earn by saving it. And understanding them can help you make much smarter decisions with the money you have. The earlier you understand that concept, the easier it is to recognize why credit scores, debt, saving, investing, inflation, and the Federal Reserve are all connected, and how you can maximize your money. Thank you for watching. Please hit the subscribe button, the like button, ring the bell, and I'm looking forward to my next video.